As we head into the final stretch of 2024, how can you best position your portfolio? Joining me now, we've got James Ragan, who is the D.A. Davidson Director of Wealth Management Research here. James, great to have you here with us today. I mean, we know that the major averages have seen some solid gains, and for the averages that have also seen, 46, 47 new all-time highs over the course of this year. A little bit of a pullback today. What would you be telling some of your clients and reminding investors out there?
Yeah, and first of all, great to be with you again, Brad. It's been a good year for investors, as you mentioned, and so we've been talking about expecting some volatility out there. But I think if you go back to late June, we've seen a rotation into broader sectors. What hasn't been led just by the tech and the growth names, and maybe in October that the tech names were starting to outperform a bit. But we're telling investors to stay diversified. Stocks are not cheap in here. We're trading at pretty elevated valuations, but we do see better relative valuations across the spectrum. And so in an environment where the economy is still growing a little bit better than expected, we're getting decent earnings growth in the third quarter. We think that returns overall, the upside should be limited, and we find better relative value in many of the sectors that are below kind of the technology and growth-centric names.
And so let's stay there for a hot second. And the technology and the growth-centered names, I mean, they've caught so much of the fanfare and the attention, not even just over this past year, but dating back even into the initiation of the AI thesis, if you will. So with that in mind, how much more legs to that trade do you believe there may be?
Well, I mean, it's going to be company specific. I mean, they're putting up good numbers. I mean, even today with the market decline coming off of last night, when I think most of those big companies that reported actually exceeded expectations. Perhaps the guidance was a little bit less than expected, but I suspect the bigger issue is just that investors are looking at the massive investment that's being made in AI and then hoping to see return on investment down the road. So there's just with valuations as high as they are, they're priced more for perfection. We still like exposure to those names, but we don't want to get too overvalued. So we would use strength, which we're not seeing today. We'd use strength to maybe trim positions a little bit and then reallocate. And we just see better relative value in some of the other stocks out there.
When you think about positioning going into 2025, where are some of the areas that investors would be missing out not to have some exposure in their portfolio, especially looking across all the opportunities in the market right now, where they would be apt to perhaps lean in or add some bit of positioning into their portfolio ahead of 2025?
Yeah, it's really interesting because the economic data has been better than expected. It seems like the recession is not coming, and we're seeing good trends leading into the end of the year. So that would tend to support having a little more cyclical exposure. So that could be financials and industrials, maybe some in the materials sector. But it's very interesting because we see some good values in some of the, like in healthcare now, where there's, tends to be a little more defensive. So what we're focusing on, we can find companies that have strong earnings growth potential. They're still putting up good earnings relative to the rest of their group, and we're seeing it across the various sectors. So we want to be just very diversified into high quality companies that have good earnings visibility.
James, we'd be remiss not to mention, of course, the major events taking place next week. And really, that's already begun, which is early voting and then, of course, Election Day next week. And ultimately, how the markets are seeing some volatility here today. But, of course, post-event, what the anticipation is. What are you expecting?
Yeah, I mean, we haven't really seen a lot of volatility, like you said, up until today, leading into the election. I don't know if that's what's causing the volatility that we're seeing this morning, but we've put out a couple notes on this. I think over time, we believe that the election results don't really affect the long-term trajectory of, say, the S&P 500 and the market overall. So we're just, I think it just argues with our earlier point to stay diversified. But that doesn't mean we can't see some volatility here leading into the election, especially if some of the results are contested. It's interesting, though. One of the comments that we get all the time, and I think we've even talked about this in the past, that the stock market investors like to see divided government. We don't really like to see a one-party control. And if you look going back to 1945, we've actually seen, that the data doesn't prove that out. The S&P 500 has done well, even in the years when we've had either full Democratic control or full Republican control. And even in the last two administrations, when President Trump came in after the 2016 election, that they had a red sweep at that time, Republican sweep. Market did very well in 2017, and then when President Biden won in 2020, they flipped it back to Democratic control, and in 2021, that was the strongest year so far of Biden's administration. So even in the recent past, there hasn't been a lot of change in the market, even when one party's taken control. So we would just step back, even if there's some near-term volatility, stick to the long-term plan. We don't think it really should disrupt what investors are doing.
Yeah, and certainly investors had been attempted to be spooked by the outcome of the previous election, and here we are, multiple all-time highs later. And the markets, what do they do over time? Well, history suggests they at least have tended to go higher here. Just lastly, as we're thinking about how someone can set up a portfolio for either outcome of the election, where is perhaps the best down the middle of the road approach that a person or an investor can take?
Yeah, well, I mean, I think this is very rough, but I think right now, Kamala Harris win is kind of, I think a lot of people associate that with maybe, better for the tech industry and some of those growth sectors, whereas a Trump win maybe is, the higher nominal GDP, but maybe with a higher deficit. So that would go for the value-based sectors or the cyclical sectors. So I think you do want to have some exposure in both areas down the middle. I think you want to pay attention to what the weightings are in the S&P 500. Technology is by far the largest weighting, of about 32% of the index now. So you want to have exposure there, but you want to spread it around in, as I said earlier, into some financial, some industrials, materials, and even some energy stocks.
James Ragan, who is the D.A. Davidson Director of Wealth Management Research. Good to speak with you once again here.
Yeah, thank you, Brad.